Okay, everybody, I'm going to go ahead and get started as it is 6 o'clock. My name is Ryan Herbert, for those of you that don't recognize my voice. Um, Welcome to the third quarter economic update, just kind of a brief snapshot on, what we've seen so far this year, kind of what we think is going to happen for the rest of the year, and then talk about some changes that are coming up. If you want to ask a question, please go ahead and just type it in the question box. Please feel free to ask as I go along. I try to keep that one open so that way I see the questions as they come along, and then at the end, I'll allow for more time for questions if we need to. So we'll go ahead and get started here. So this is an old photo of the team. We just had new office photos taken 2-3 weeks ago. So I'm going to get a new updated photo for us there because we've added some people and lost some people since this photo. That's me and Mike. For those of you who don't know me, like I said, I am the one on the left. However, now I have the COVID beard that pretty much a lot of people grew from that point on. Just some places you've seen Mike or myself featured in the area. We have the weekly radio show on 105.7 The Fan and 680 AM, and then we also have it on 2 channels down there in Orlando, Florida. Informational purposes only. Past performance doesn't guarantee future results or anything like that. Really, this is kind of a commentary on the equity markets and the fixed markets. Not a crystal ball, just really kind of the things that Mike and I and the team are looking at when we're making these investment decisions. Really, we have kind of a lot of things going on in really our global economy. The big news a couple weeks ago was Evergrande, which is the world's one of China's most largest property developers. They're extremely leveraged, and they started defaulting. They're not meeting their debt obligations. They're not paying their interest payments to those companies. But we had, so that's kind of was leading a lot of the volatility towards the end of September. The global COVID case counts have started to drop after we had our Delta variant surge through the summer, and there's still a lot of up in the airness when it comes to those boosters and the new pill that just came out. So there's a lot of medications and a lot of procedures that are out there to kind of treat COVID. But really kind of the uncertainty really has a lot of investors on edge as to whether it can trigger another rise in cases and potentially more shutdowns. We have late September elections. So those elections are just wrapping up now in Germany and Japan. Those are the third and fourth largest economies. It's going to take months for Germany to form their new government, which really raises concerns around the future policy direction because it is no longer Angela Merkel at that point. Shipping log jams. It seems like every day you turn on the news, they're talking about container ships being backed up in the port in California. They're at the worst levels of the pandemic, which just really raises risk to sales, manufacturing, production, and inflation. A couple of weeks ago, Meredith and I were on vacation, and we were flying into LAX, and I happened to look out as we were flying into LAX, and the amount of ships that were anchored, and this was back in late August, the amount of ships that were anchored outside of the port in the LA area, which I'm assuming was the Long Beach port, was really kind of shocking. It was a huge number of ships. So those are all really the risks we have to the global world economy and the stock market at this point. hold on one second here. Okay. So, the S&P 500 really has climbed pretty steadily for year to date, up more than 20% as of the end of September. Just a reminder, September and October are always very, very volatile. The whole Evergrande catastrophe really showed us stocks took their largest drop since May. But one thing to remember as we go through October is that it's typically the more volatile of the 2 months, one of the most volatile months of the year. Looking beyond the next few months, because really we're talking about the short-term worries that we have, the 2022 global economic environment is going to be pretty favorable for investors. A lot of the central banks are getting ready to pull back on the pace of their stimulus. They're focusing on the expected growth that they believe we're going to see in the world economy and overall inflation. One of the organizations that tries to forecast growth is showing that every one of the 45 major economies in the world are going to be experiencing growth next year, especially since we had a lot of contraction in 2020. This is the red that we see here. This is our contraction, not a lot of growth here. 2021, pretty much we had a whole lot of growth, all 45 countries. And then over here, once again, 2022, we're expecting a pretty strong growth throughout the 45 major countries, major economies. What we've seen overall through the year is that the S&P 500 index really has suggested a relatively tame market. There hasn't been a lot of huge ups and downs. There hasn't been a lot of huge swings, but underneath the surface of the S&P 500, there's been a lot of individual pullbacks in the stocks that make up the S&P 500. And I've been talking about this ever since kind of September of last year, and kind of every quarter, where from March of 2020 through September of 2020, the S&P 500 saw this huge growth, and all of the growth was driven by 5 stocks: Facebook, Apple, Netflix, Google, and actually 6 stocks, Microsoft. Those stocks made up for 90% of the growth in the S&P 500. Over that time period, those particular stocks were up 20 and 30%, whereas the rest of the S&P 500 as of September of 2020 was still down 7%. So all of the growth that we've seen in the S&P 500 really has been led by those 5 large stocks, which make up a good bit of the capitalization of the S&P 500. So, sector rotations, people moving in and out of sectors. Mike and I utilize this strategy as a part of the overall portfolio. Really has remained pretty sizable. There's lots of movement in and out of these sectors. Many of the stocks in the S&P 500 have reached correction territory, but overall, the S&P 500 itself has yet to see even a 5% correction. As I was saying, the S&P 500 really has seen yet to see a pretty large pullback. But really what we see here is, the number of members of the S&P 500 that have at least had a 10% pullback in the market so far year to date is almost 90%. Here's the overall drawdown in the S&P 500. We haven't hit that 5% mark. The GDP expectations in the United States projections are really falling. Third quarter of 2021, the forecast is showing we're going to have a pretty huge drop off in what our GDP numbers were going to be. And now we can see our fourth quarter GDP forecast they're expecting that to come down. This really is because of the supply chain constraints we have. I talked about the huge log jam in shipping. Really, that just kind of falls in place across all of the industries. We see all industries are having labor shortages: manufacturing, retail, restaurants. There's all these shortages. That supply chain is going to trickle down to lower retail sales, like I said, which is going to have a very negative impact on GDP. Inventories, because of the supply chain problem we have, are pretty depressed. Our second quarter GDP was slower than normal. It was a lower level than we were expecting. Even consumption, people buying things really is starting to slow. So we're seeing this turn down in GDP, and it's something that we don't need to be concerned about at the exact moment, but it is something that we need to be cognizant of as we're going forward. We're going to see sharp swings in the sector rotation market. We're going to see swings in which of the sectors is outperforming the other. So, we continue to have our factor-based approach that really focus on the fundamental factors when we're looking at areas of the market to invest, which areas have higher cash flow. Like I said, at the most recent Fed meeting in September, so a couple weeks ago, the Fed said it's going to begin reducing the pace of its bond purchases and wants to raise short-term interest rates by the end of the year. This is really what they anticipate doing. They want to start their tapering of their buybacks, not buying so much treasuries. They want to start it in November, and they really want to continue to taper throughout the rest of the year, all the way through 2022. Right now, they're buying around $8 trillion of bonds, and they want to start tapering that move off so it starts to level out, and then eventually will turn and start coming down. So they're buying less and less of these bonds a month. Rate hikes. This is the one thing that Mike and I really have been talking about. If we're in bonds, the 30-year Treasury bond at this point is paying 1.8%. What we're seeing here is the Fed funds rate, which is the short-term rate. As they start to raise interest rates, the prices of existing bonds will fall, because if you have a $1,000 bond that pays 1.8% and they start issuing new bonds paying 2.5% or 3%, why is someone going to give you $1,000 for your 1.8% bond if I can go out and spend that same $1,000 for my 2.5% or my 3% bond? So if you're in those bond funds, you want to be cognizant of what's going on with interest rates. By the end of 2022, the Fed, right now we're basically at zero with the Fed funds rate. By the start of 2024, they want to get this rate up to right around 1%. The pace at which they do this really is going to depend on how the overall economy is doing, how GDP is doing. We expect to see the rate hikes start to come in next year, maybe get us right around 0.5%. By the end of 2023, probably somewhere just below 1%, if not right around right at 1%. Throughout 2024, we should see another increase as long as things continue. And in the long term, the Fed really wants to target that rate of 2.5%, 3% for their Fed funds rate, which gives us much better interest rates in the future. Really, this kind of fits into that bond replacement strategy that Mike and I have been using, where we have the money in the alternatives at this point. Once rates rise, we will make the move out of those particular investments and go back into a traditional bond portfolio where you're earning 3, 4, 5% versus right now where you're earning less than 1% in those overall bond positions. I want to talk about some tax law changes. These are the proposed changes that are out there. I've been getting a lot of questions about this when people come into my office, when I'm doing the seminars, when I'm doing the workshops. People are asking about this. The one thing that has seemingly been taken off the table is that elimination of the step-up in basis, which means when you pass away, your kids inherit your house, your kids inherit your stock at the face value when you pass away. They were talking about getting rid of that. It seems like that is off the table at the moment. Some of the bigger things you should be cognizant of, they're talking about increasing that top marginal income tax rate from 37% to 39.6%. It doesn't affect a lot of people, but it is something to be aware of, especially if you have highly appreciated assets that you're thinking about selling, or you have a vacation home, a second home, an investment property, a rental property you're thinking about selling, and you're going to realize a large gain. You know, they're talking about that upper level is anyone for a single filer who makes more than $452,000 a year and $509,000 for married filing joint filers. They're also talking about taxing long-term capital gains and dividends as ordinary income if you have more than $1 million. Really, once again, it's not a lot of people that are affected by this, but this is where it comes into play if you're selling something that's been highly appreciated. If you're selling a rental property, if you have an inheritance with a lot of stocks in there and you're getting ready to sell it, if it's going to push you up close to that $1 million, instead of paying those capital gains tax on those types of things, you might be paying ordinary income. They're talking about taxing capital gains, taxing your capital gains at death for any unrealized gains over $1 million. Really, this has to do kind of along the lines with that elimination of the step up in basis. This part is really kind of in flux at this point. You know, they want to expand that net investment tax. That's that special Obamacare surcharge, and say they're going to apply it to every income source for anybody who makes more than $400,000, including that pass-through income. Talking about reducing the estate tax limit. Right now, you can pass $11.7 million without worrying about estate tax. This is not something that affects a lot of people, but it is something that people should be aware of because now they're lowering it down to $6 million. Making it a $6 million number does make this actually affect a lot more people. If you remember years and years and years ago, it was 2.5, they raised it to 5, and then they went up to this $11.7 million number. There are some possible changes for the tax rules for exchange-traded funds. Right now, all the transactions inside of the ETFs, when the ETF itself is making changes inside of it, whenever other ETF holders are buying and selling their ETFs, there's no taxable consequence to you as the shareholder if you haven't done any transactions yourself. You hear Mike and I talk all the time about why we aren't fans of mutual funds, because if you're holding them in a brokerage account, you can get a tax bill for them at the end of the year, even if you didn't do anything with them. That's why Mike and I are really big proponents of exchange-traded funds, because they don't function like those mutual funds. Well, there's talk right now of making the exchange-traded funds taxable as they would be if it were a mutual fund. This is one of those wait and see approaches. If Mike and I feel that this is something that is going to happen, we will be changing the investment strategy because we are very, very, very tax consequences, very, very tax cognizant. They're talking also about making changes to the rules for corporate stock buybacks. Really, it also has to do with raising the corporate tax rate from 21 to 28%. When Trump cut the tax rate from 28% down to 21, that put a lot of money back in these corporations' pockets. What did they do? The intention was for them to go out, spend more money on their company, invest in their products, invest in their company, pay their employees more money. What these large corporations did instead was they said, we're going to take all this money we're saving from the 7% income tax cut, and we're going to buy back our stock. we're going to buy back our stock because it's going to make our company look good that a lot of people are buying our stock. It's going to drive our stock price up. Also, what we're doing is we're getting more ownership in our company back because we control more of the stock. They're talking about changing the rules as to how much corporations can buy back every single year, what money they can use. All of the growth that we saw from when Trump was elected and he put this tax package in, a lot of the growth in the stock market was driven by all these companies buying back their stock, pushing the price of their stock higher. That's kind of what we've seen throughout the years since Trump was elected. Even in the Biden presidency, we're still seeing that. If they change those rules, that is going to have a pretty big impact on the market, because if they're changing how much stock they can buy back and then they're going to raise the taxes back up, that's less money these companies can spend on buying back their stock, which won't push the market up continually. Okay. So, I know everybody at this point should be aware that Mike and I have hired a couple new members to our team. We hired Alia, we hired Lawrence, we hired Faisal, and then there's Jessica, who's been with us since tax time. Everybody should have gotten that letter really introducing everybody, so you have a name, a face to put with the name when you call the office and you're speaking to somebody new. Some changes that Mike and I are going to implement going forward for 2022 has to do with the transaction costs inside of Charles Schwab. The SEC has challenged Mike and I on the issue of the transaction costs. For years and years and years, ever since Mike and I have been in business, ever since I've been with Mike, we have always covered the transaction costs for all of our clients. The SEC's concern is that Mike and I won't take action, we won't trade in your account because of the fees. They feel it might restrict Mike and I from trading. The fees that we're talking about are really cents, 2 cents, 3 cents, 4 cents, 10 cents when it comes to trading them. Mike and I disagree with the SEC because they are saying instead of us covering those costs for all of our clients, they want us to pass those costs on to you as our clients. We absolutely disagree with them, but we're going to have to go forward with what the SEC is asking us to do. We don't expect it to be a rather large increase, somewhere in the range of 0.1 to 0.3% overall. Really, to help counteract that fee, Mike and I brought in a new trading platform. This is something that you don't see. It's behind the scenes. Normally, when we purchase in accounts, we buy and sell. We buy in lots. We place big orders at a time, and they are filled slowly. So if I want to buy 100,000 shares of XYZ, I place the order for that 100,000 shares, and it fills at maybe 10,000 shares from this place, 20,000 shares from another, and it continues to do that till it fills up all the shares that I'm ordering. With my new trading software, what it allows me to do is purchase all 100,000 shares in one place. So I'm cutting down on the overall cost per transaction. It's not a lot that we're actually doing, but when I use this new trading software, what we're seeing is it's going to equate to an increased return, probably somewhere in the range of 1 to 1.5% greater return, because I'm able to eliminate this cost or greatly reduce the overall trading costs for the clients. If you want to have a further conversation about what this means for you, what this means for your particular account, I encourage you to call the office, 410-863-1040. Set up a time to speak with myself, set a time to speak with Catherine, or set up a time to speak with Mike. And that really is kind of the end of my presentation for the night. Thank you, everyone who has joined. I apologize for the interruption, as I'm home with my youngest daughter. So I apologize for that, but hopefully everybody learned something tonight. And I hope to see everybody in the office soon, because we are in that fall review season. So you should be hearing from the office soon. So that is everything for now. I'm going to go ahead and mute myself, but I'm going to sit here for a couple minutes. If you have any questions, please feel free to go ahead and type them in. And I got one here. There we go. Well, thank you, Norman. I'm sure the highlight was my daughter yelling at me and being upset because she heard something outside. Okay, everybody. I'm going to go ahead and terminate the webinar for this evening. If you want a recap of this, I do record my overall, I do record this seminar, I do record this webinar. Please feel free to reach out to the office and I can email you a copy of everything. And if you want to have a further discussion about anything I talked about, please, like I said, give me a call at the office, 410-863-1040. Thank you, everybody. And I will talk to everyone at some point in the office. Thanks, and have a good night. I'm going to skip this one because this is not one, that one's not supposed to be here. But